right, my beautiful apes out there. Good afternoon once again. First things first, I know we are getting started a little bit later than promised yesterday as well, but when you have somebody like me who understands computers about as well as George Washington did, then, it gets a little bit difficult, but the rest of the team is trying their best to, get me set up right. But we're looking good to go now. So thank you all for joining me here today. No, it is about 12:30 p.m. here Eastern time, so we've had about 3 hours of markets action for today. We're still going to be going over the stuff from yesterday that came out in today's Daily Peel. Do promise for you guys going forward, once we get this stuff figured out, it will be within that 10 to 10:30 a.m. Eastern time kind of time frame. And, you guys here with us on the early days, you're going to look back at this a week, a month, a year from now and say, oh, I remember those early days when David was always on much later than usual. But either way, let's get into things here today. As you guys know, my name is David, coming at you live from the Daily Peel Global Headquarters, location undisclosed, as the lead writer for the Daily Peel, to get into everything's markets here today. So looking over on the right-hand side of the screen, much more attractive than looking on the left-hand, if I don't mind saying so myself. What we have here in today's Peel is, of course, going to begin with Buffett's Berkshire Hathaway's earnings. So we're going to dive deep into that. Those came out this past weekend on Saturday because, like we said yesterday, Buffett and Munger are better than you, they're better than me, and they're better than pretty much everybody else. So they can do things like that. We're then going to move into a couple of stocks today. We did have another instance of securities violence committed against shareholders by Dish Networks. So we'll definitely get into that. Then down below, we'll have the least talked about economic indicator that actually matters. Don't know why the mainstream media isn't reporting on this, but it seemed pretty important to us. So we'll get into that down below. Now, today is, of course, November 7th, aka 7/11. Very small cap holiday we're increasingly bullish on. Thank you guys as well for joining us today with the live, and it made it a lot easier on you Californians out there as well. So now there's really no excuse for you not to be here. Now, markets did overall have a pretty good day yesterday, as long as you weren't a small cap stock, because we did see a decline in the Russell 2000, but everything else tended to rise pretty decently. It was a large cap led day. Wasn't exactly a whole lot of news going on. Mondays tend to be lighter and during earnings season in terms of reports that are coming out, as well as Fridays. And keep in mind that every company wants to report on a day when as many other companies are reporting as well, so that, investors generally pay as little attention to their report as possible. Unless, of course, they do really well, then they'll make sure that you know it. Treasuries kind of continued their, general bouncing around, not really making a whole lot of sense. But we did see a large move downward from the 10-year, continuing that move from Friday when the jobs report came out. That inversion did spread just a little bit. However, the 2-year hasn't been able to cross back above that 5% line. Keep in mind that 5% is very important psychologically even. Might not matter necessarily, mathematically or really with anything to do besides psychologically, but either way, those psychological levels really do kind of drive the technical factors there. Moving on into the banana bits here, I want to shout out some of the most important kind of news articles that we saw yesterday. Sam Altman is apparently a big fan of 1950s cars, naming the latest version of GPT or ChatGPT after, what sounds like a 1950s car brand, and GPT Turbo. This comes just days after Grok AI was released. So clearly, Elon and Sam and their ongoing beef that nobody really talks about is still raging behind the scenes. We'd love to get some inside scoop on that. I'd love to be part of those group chats, but maybe someday we'll get a leak, and I'm sure it'll be pretty funny. But as companies continue to struggle to fill their city-based offices, of course, nobody wants to go back to work, especially not when you have to sit through traffic. But however, some commercial real estate developers are seeing an opportunity to convert these properties into apartments, as young people still do love to live in the cities and be part of that nightlife. So they don't really know what they're getting themselves into for the most part, but still it's a big opportunity for them. As well, this was a pretty funny story. I just happened to see on Twitter. Actually, I think one of my friends even texted it to me, but apparently there was a Bored Ape Yacht Club conference over this past weekend. There was some kind of problem with lights, and the NFTs investors, some of them actually went blind, or at least legally blind, maybe temporarily. We don't really know, but the irony was not lost on us for somebody so blind to not see that NFTs have become basically worthless, to go to this conference and actually have to become physically blind in order to understand those. But that does suck. Definitely don't want to wish harm on those people. I got contacts in right now because I can't see myself, so definitely don't want to judge. But then again, on the other side of the crypto equation, we did see quite a lot of inflows going in last week to various projects. Apparently, people still want to lose money, so we'll see how that goes going forward. Now, moving on to the actual news of the day, this begins with Buffett and Berkshire's earnings. So, like I said, Berkshire dropped earnings on Thursday. We got some commentary from Buffett, Munger, the rest of the team there. But the most important thing in this report, and we'll just skip right down to the important data here, look at this cash pile, $157.2 billion currently sitting in cash and cash equivalents. That means this company could buy the likes of Disney, Wells Fargo, and whatever the other one I said was in there. I mean, with ease, without having to take on any debt. They could do that within the next couple of weeks if they really wanted to do something like that. But they also did suffer some losses in their investment portfolio. They got declines from that because, of course, when you sell out of the investment portfolio and put it into cash, it's going to decline on that basis. But much of this down draw was driven by the actual performance of the securities. With the biggest culprit being Apple, of course, is their largest holding in the S&P 500. It's had a rough past quarter or so. They did also jack up their holdings of U.S. Treasuries by close to 36%, and they are still absolutely killing it. So shifting gears to look over at their earnings statement, I know don't go too crazy on me just yet. It is incredibly boring stuff, but we do have to shout out this line item here, the short-term investments in U.S. Treasury bills. Look at that jump from $92 billion at the end of last year to well over $126 billion right now. But if we scroll down a little bit, it's an interesting way how Berkshire actually reports its income statement here. So as you guys know, Berkshire is a giant conglomerate. There's no real way to kind of summarize that in a way that makes it easy for us to understand their business and especially not model it. But they do try their best to break it down between the insurance and other categories, as well as railroads, utilities, and energy. It is mostly kind of a utility stalwart stock. It's the definition of a blue chip company. If you buy Berkshire, you're really betting on the American economy in the most pure way possible as far as it comes from equity performance. But up in this other category would include things like Fruit of the Loom, NetJets, and all that other good stuff that we talk about down below, both of which actually had fairly decent quarters. So we saw some strong performance from the likes of NetJets because essentially what NetJets does is allow you to purchase ownership of a private jet that you can then fly around in. Don't really know who's doing that, but apparently people are. It's kind of like a timeshare for private jets. But so that has performed pretty strongly, whereas the rest of the business was kind of suffering. Either way, they did see a 40% jump in overall operating profit. So that's why we say, even though it was, certainly not the best quarter for the 93-year-old Buffett and the 99-year-old Munger, certainly could have been a whole lot worse. I don't know a lot of 99-year-olds that are driving 40% improvement in their operating earnings. So either way, we're impressed there. Great quarter, Berkshire. Moving on down below, and speaking of great quarters, we have Freshpet. This is one of those bougie dog companies that, millennials that live in big cities will buy and actually apparently refrigerate their dog food for. I can confirm that it does taste pretty good, but please just don't ask me how I know that. Either way, the company did have a great quarter. Shout out to my dog, Roscoe, who does eat Freshpet, of course, because he is the best and deserves nothing less than that. So the company, they are still losing money. They did lose less than expected at 15 per share instead of the 18 that was expected. Revenue beat as well, very slightly, but still, when you're a company of this size and this scale, what they want to see is that you're delivering that outperformance, whatever the degree to it actually is. Pretty much any outperformance is going to drive quite the move in the stock return, like this 16, almost 17% jump you see. Plus, still, revenue did grow 27% from last year. This is also in a time when, economic uncertainty dominated throughout 2023. Even though we might not have been in a traditional recession, the uncertainty still made consumers somewhat, to a certain degree, act in that manner. Although aggregate consumer spending may not have changed too much, the purchases that consumers are choosing to make certainly has. But to see them not turn away from kind of a premium dog food brand is a strong sentiment for overall consumer spending, which is, of course, about 65-70% of the U.S. economy in any given year. So we, of course, always love to see that. Moving on down below, we have Booking Holdings. Booking is one of those companies that, your mom and dad probably use to book trips because they don't understand that doing things on separate apps is a hell of a lot easier. Now, what Booking allows you to do is set up the flights and the hotels and all that good stuff. So they've really been riding the wave of this kind of return to travel that we've seen over the past year since we were all freed from being locked in our rooms and cooking sourdough bread, whatever other nonsense you get yourself into. But either way, Booking Holdings did not have a very good quarter. However, CEO Glenn Fogel is a master in calming nerves, apparently. If we didn't know that before, we certainly just learned it, as he really was cool as a cucumber on Thursday evening when they were going over their earnings calls. Basically, he was letting people know that very similar to when the Russian invasion of Ukraine began, the outbreak of war in the Middle East has tampered some travel demand. So that's going to hurt their bottom line. They kind of paid for that somewhat towards the end of last week. But what happened on Monday was D.A. Davidson came out with a big upgrade. Apparently, they were buying what CEO Glenn Fogel was selling, and that it won't be too bad, and that with just a couple of months' time, some normalization will return, very similar to what we saw when war broke out in Eastern Europe. Now, moving on down below to that securities violence that was committed by Dish Networks yesterday against investors. The stock almost crashed 40%. I mean, as far as I remember, this company was, you know, I mean, I don't remember seeing an ad for them since 2006, maybe. So I kind of always forget they exist until I see a huge movement in their stock price. It was so bad, you would think the greatest trader of all time, Nancy Pelosi, was actively selling shares. However, what they really did was actually just have the most garbage earnings report you could imagine. So people were expecting about 11 cents per share in earnings. Instead, they got a 26 cent per share loss. Excuse me. I promise I can speak English. So it was really bad. The company is undergoing a sort of restructuring, so we do give them some kind of credit for that. Clearly, the market wasn't, however, sending shares down over 40% as this piece of garbage seems to be heading on its way out. Speaking of pieces of garbage, we can look at Hilton Grand Vacations. I don't know what investment bank is advising them on this deal, but the stock absolutely dumped yesterday because of an acquisition. That's not entirely unusual to see stock sell off when it's acquiring another company. It's especially not that unusual when you're paying a premium of well over 106% for that company that you're applying for. Somebody absolutely got fleeced in that deal. I don't know who it was. Again, I don't know what investment bank is advising HGV, but because of that boneheaded move, paying $1.5 billion for a company that was worth less than $750 million on Friday, really doesn't make a whole entire lot of sense. But either way, what these companies both do is essentially actual timeshares, very much like Berkshire's NetJets business that we talked about just a couple of minutes ago. And so, don't really know who's signing up for timeshares lately these days, although I did see recently that you can actually pay to live out the rest of your life if you're kind of a retiree or an old person on a cruise ship. Apparently that's blowing up. Don't really know why anybody wants to be lost at sea. I guess I haven't seen the movie Castaway, despite the fact that that is a great movie and that Wilson the volleyball is one of the greatest characters of all time. Either way, tough day for HGV shareholders and the rest of the industry. Now, moving on down below to the most underreported story of the day, that's going to be the sluice noose getting loose. I'm very proud of that rhyme, so I obviously have to include it here. But what SLOOS stands for is the Senior Loan Officer Opinion Survey on Bank Lending Practices. So yes, we all know the Federal Reserve loves their complicated names. And while the reporting that you're going to see on it from places like Seeking Alpha and other sites that are on it are, still focusing on the restrictions that are going on, it's actually kind of lightening up. And that's what we chose to focus on here. And I think the best way to do it is to go over to the report here. Just to give you guys an FYI as well, when the Fed releases these economic reports, they show it in kind of a text format on their site. Click into the PDF if you want to see the charts, and that's how we get things like this. So let's take a look at exactly what we're seeing here. This first one, measures of supply and demand for commercial and industrial loans by size of firm. So as you can see over here, this is basically measuring the net percentage of domestic respondents that are tightening standards for commercial and industrial loans. So it's the net percent of banks that are actively tightening their standards. As we can see here, most of them still are tightening those standards. It's right around the 40%, 35% mark here. However, it was up much closer to 60-ish percent, 55, 60% beforehand. So seeing that move in the right direction is an indication that lending standards are not getting looser, but that the companies behind them are moving in that direction, and we should see that continue. That's been happening since July, and really since that hawkish hold that the Fed did with the federal funds rate back in June of this year. And you can see trends like that pretty much all throughout this report. You see this quick pivot back in July. That's been continued since here, and that once again continued down below with commercial and industrial loans once again. Then we get into more consumer demand. Now, it's definitely not as pretty or as clean of a picture here. They also don't report it as well because, as you can see here, they stopped the all commercial and real estate loans back in about 2013 and now split it up by the kind of loan. Whereas if we go down even further and get into mortgage loans, so these are the kind of ones that you home buyers are going to be suffering for the next 30 years if you actually do sign up for one of these. So as we can see, all residential mortgage loans, that stopped right about when the economy absolutely obliterated because, real estate loans were going to, let's just say, not the most deserving borrowers ever. But as we can see here, there is another slight uptick in people that are essentially tightening those standards. A little bit of a different story in the residential real estate market, just given how, shattered everything is since Jerome Powell kind of dropped that nuke on us with the interest rate rises. But in that sense, we are seeing things once again move in the right direction, or at least stop moving in the wrong direction, which is arguably just as important. Like we get into a little bit here, it's often not the actual level that economic indicators are at, but it's the direction that they're moving in, because it's really expectations that are going to be driving everything. So to see that moving back in the right direction for us is effectively as good as seeing that, kind of an actual good print, because it just means things are moving back in the right direction. And yeah, so that pretty much covers everything that we were looking for here today. We're, of course, wondering if loan officers are going to continue to tighten those standards. What's going to come out for that next report? That's one that comes out quarterly, so we'll be waiting for about another 3 months for the sleuth report. But either way, you definitely want to be on the lookout for that. It's one of those reports that, is never important until it actually is. And so right now is one of those times. Definitely be on the lookout for it. And then, of course, because we shouted out the cryptocurrency and digital asset market towards the beginning of those banana bits with the NFT project and them going blind and everything, we had to point out this Milton Friedman prediction from way back in 1999, the year in which I was actually born, saying that, the internet is a great thing, and the only thing it's missing is a reliable e-cash. That's one of those things that all these Bitcoin hardos, that are super annoying on Twitter and telling you to stay poor and, seem to be praying to Satoshi Nakamoto every night. That's one of the things that they like to shout out as proof that Bitcoin is here to stay. I don't know. I don't think anybody really knows. That's for you to decide. Go ahead and place your bets. We'll be back with you tomorrow, and we're going to try our best to be on time within that 10 to 11 a.m. Eastern time frame. Either way, thank you guys so much for joining us here today. Promise it's going to get better going forward, and we hope to see you there. Everybody have a good one. Bye now.